Imagine you wake up tomorrow and everyone has the same idea. Not just you, not your city, everyone. They walk to the nearest bank, they open their apps, they hit withdraw all, and suddenly the banks don't have the money. That sounds impossible. You put money in, they owe you money, so they should have it. But here's the uncomfortable truth. If everyone tried to withdraw their money at the same time, the modern banking system would collapse in hours. Let's slow down and walk through why. Think of a bank like a massive neighborhood piggy bank. You put your money in for safety. Millions of people do the same. But the bank doesn't leave that money sitting in a vault. They lend it out. They give mortgages. They fund businesses. They finance credit cards, car loans, governments, corporations. So your money is not actually sitting there waiting for you. It's out in the world, working, earning interest. This system is called fractional reserve banking. It sounds complex. It's actually simple. If a bank gets $100 from you, they might keep only $10 in cash. The other $90 is loaned out. Those loans get deposited in other banks. Those banks keep 10% and lend out the rest. Your original $100 can turn into hundreds or even thousands of dollars in the economy. It's how money multiplies. But there's a trade-off. The bank only works if not everyone asks for their money at the same time, because the money isn't there. Now imagine a rumor spreads. People hear the bank is in trouble. A few customers withdraw their cash just in case. Others see the lines forming. They panic. They withdraw too. This is called a bank run, and history is full of them. In 1930s America, thousands of banks failed this way. People literally ran to banks. They stood in lines that wrapped around city blocks. When the doors closed, many never saw their savings again. Fast forward to 2008, people didn't line up outside banks. They lined up digitally. Investment banks collapsed. Governments stepped in with trillions to stop the panic from spreading. And in 2023, Silicon Valley Bank failed in just 2 days, not because everyone showed up physically, but because billions were withdrawn with a few clicks. Technology made bank runs faster. Fear made them unstoppable. So what actually happens if everyone tries to withdraw their money at once? First, banks run out of cash. ATMs go empty. Branches close early. Apps freeze or limit withdrawals. Banks don't fail because they're evil or stupid. They fail because they're built on trust. And trust evaporates faster than money. Second, governments step in. Central banks pump emergency money into the system. They guarantee deposits. They calm markets. In many countries, your deposits are insured up to a certain amount. That's why most people don't panic. They believe the government will step in. But here's the uncomfortable part. If literally everyone withdraws at once, governments can't cover it instantly. They would have to print massive amounts of money or freeze withdrawals. Yes, freeze. Some countries have done it before. Limits on daily withdrawals, capital controls, temporary bank holidays. Because letting the system collapse would be worse. Third, markets crash. Banks are the plumbing of the economy. If banks freeze, businesses can't pay workers, people can't pay rent, companies can't borrow to survive. The economy seizes up like an engine with no oil. This is why central banks treat bank runs like fires in a nuclear reactor. They must be stopped immediately. Now here's the part most people misunderstand. Your money in the bank is not a pile of cash with your name on it. It is a promise, an IOU. The system works because not everyone wants their money at the same time. just like airlines sell more tickets than seats, expecting some people not to show up. It sounds risky. It is risky. But it's also why modern economies grow. If banks had to keep every dollar in a vault, loans would be rare. Mortgages would be impossible for most people. Businesses wouldn't scale. The economy would be slower, smaller, poorer. So we built a system based on controlled risk and trust. Trust that banks won't collapse. Trust that governments will step in. Trust that most people won't panic at the same time. But trust is fragile. One tweet, one rumor, one leaked report, and people can stampede. That's why regulators stress test banks. That's why central banks monitor liquidity daily. That's why deposit insurance exists. Not because the system is breakable, but because it's breakable in very specific, terrifying ways. So, should you be worried? In normal times, no. The system is designed to handle withdrawals, recessions, even crises. But it is not designed to handle everyone panicking at once. And that's the paradox. Your money is safe because you believe it is. The moment everyone stops believing, safety disappears. Now think about this.
Most of your money today isn't physical cash. It's numbers in databases. If everyone tried to withdraw physical cash, there simply isn't enough paper currency in existence. The global economy runs on digital trust. So what happens if that trust breaks on a massive scale? Would governments print unlimited money to save banks? Would they freeze accounts to stop chaos? Would digital money become more controlled, not less? And if the system only works because people don't test it, what happens the day they do?